Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Pete Cahill, one of our senior portfolio managers. Pete, we talk often with our clients about the Federal Reserve and corporate earnings being two of the biggest contributors to asset values. And we know the Federal Reserve really has a dual mandate: stable prices and full employment. Obviously, stable prices has been a bit of a challenge in the last 12 to 18 months. So, Pete, why don't you update us a little bit on inflation?
Yeah, certainly, Paul. Last week, we received the CPI report. The Consumer Price Index is an economic measure that's widely followed to gauge levels of inflation. The headline on the report was that inflation was lower than the market expected. That was welcomed by investors. It led to higher stock prices, higher bond prices, and in fact, by close of business on the inflation report, the Dow Jones Industrial Average had gained nearly 1,200 points that day. The headline number was 7.7% inflation year over year. That's a high number. It's an unacceptably high number. However, the market was expecting a number of 8%. So for the investors so inclined, the narrative that inflation is moderating was reinforced. If you take a look at this graphic here that we put together of where CPI has been over the last 10 years, you'll see a couple of things. First, for the bulk of the decade, inflation has hovered around 2%. And 2% is the magic number with the Federal Reserve, Goldilocks, if you will, not too hot and not too cold. You'll also see, starting in March of 2021, inflation started to rise dramatically, going to 9% this summer. Those levels are historically damaging to the economy and to the consumer. So what has the Federal Reserve done? The Federal Reserve has started to raise interest rates in a dramatic fashion, attempting to cool inflation, to dampen inflation. What this chart shows is we are not at 2% yet, but directionally, we're moving in the right direction. So some cause for optimism.
So it clearly is better news in the markets. In the markets, it was well received, and so it's really a fascinating time of the year for us. Not only do we have the Federal Reserve active, but it's also an active earnings season. We're coming near to the end of that. So in the graphic we're going to put up next, we talk a lot about earnings and the importance to stock valuations. You can see the graph; they match up pretty well. Earnings growth and the S&P going higher. So Pete, why don't you talk about what we've seen in this year's earnings season?
Yeah, so we've come through the third quarter earnings season. As of late last week, more than 90% of the companies in the S&P 500 have reported third quarter earnings. And the headline on earnings season is that earnings have been better than feared. With all the talk about recession and inflation and anxiety this year, many investors had worried that corporate earnings would fall off a cliff. And quite frankly, as we sit here today, they have not. Expectations have come in, but they're still positive for growth. In fact, as of this shooting, the S&P 500 is expected to grow earnings 6% this year and 6% next year. So good, not great, not horrible. Earnings season is in the books.
We'll take good at this point after what we've been through in 2022. So what other observations might we garner from the earnings announcements?
Yeah, one of the things we look at closely at First Source is something that's referred to as the beat rate, and that's the percentage of companies that surpass Wall Street analysts' earnings expectations. This past quarter, the beat rate was nearly 70%. That compares to the historical averages of 75%. So while it's slightly below where we've been historically, it's still at a level that if you had asked us, would you take 70% of companies beating expectations back in September? The answer would be yes, we would. So again, earnings season better than feared.
So, Pete, as always, we really do appreciate your comments. In the coming weeks and in the month of December, we'll be sharing our 2023 outlook through a series of videos, so be looking for that in your email. And as always, thank you for the opportunity to serve you and your family, and have a great day.